Not so long ago, South African assets were deeply out of favor and unloved. But more recently, we've seen a change around the perceptions of local equities as more positive sentiment has started coming through after the formation of the Government of National Unity. Joining me today to discuss how PSG Asset Management approaches the selection of local equities is Fund Manager Mikhail Motala. Welcome, Mikhail.
Hi, Audrey.
So, Mikhail, to kick us off, PSG Asset Management runs a globally integrated process. But can you explain to us what this means?
Sure, I think that's a great place to start. A global integrated process is one where there's one investment team that is responsible for all the decision making, particularly around geographical exposure for the portfolios. Now, with the advent of regulation changes that allowed for funds to take up to 45% offshore, it's introduced certain nuances in the way funds are managed. I think one of the nuances I'll call out is where fund managers have typically outsourced the global allocation process. Now that almost half of the portfolio can be outsourced globally, it introduces certain nuances like business risks. We don't have that conflict of interest where there's an integrated global process. So at PSG Asset Management, we have one investment team that is responsible for analyzing and selecting securities, both in South Africa and abroad. It's an integrated process.
So how does this process translate when it comes to selecting local equities?
Yeah, it's an interesting asset class, South African equities. So let's call out three factors. The first is if we look at South African equities as an asset class, the index that is most representative of the South African market is the Capped SWIX index. Currently, the Capped SWIX index is around 50% exposed to the South African economy. So only half of the actual equity market has anything to do with the South African economy. The other half is split between mining stocks and then non-mining global companies that just happen to be listed in South Africa. The point being that even if one is only restricted to the JSE, one is still running a global allocation process because a fund manager has to decide how much goes towards SA Inc. and how much goes to global. The second factor I'll call out is when there's a global integrated process, the fund manager can select the best opportunity irrespective of where that security is domiciled from a listing point of view. So if we look at the oil and gas sector as an example, on the JSE, the only counter is Sasol. Globally, there are many counters. So in a global process, one can invest in the likes of Shell over Sasol. And then the third factor I'll call out is the way we look at our funds looks deeper than just the crude distinction between the JSE and offshore, because that doesn't capture the full picture. We prefer to look at the funds on an integrated process, so in an integrated way. And what that means is that we'll consider how much of the fund is exposed to the South African economy, how much of the fund is exposed to the commodity or resources sector, and then how much of the portfolio is exposed to global value companies. And that's a far better way to look through the analysis of the portfolios.
Mikhail, when it comes to a fund that provides an example that we can look at to give us an idea of PSG Asset Management's track record when it comes to managing local equities, the PSG SA Equity Fund comes to mind. Now, this is a high conviction local equity fund, and looking at the track record, we can see that it's outperformed Capped SWIX over most periods. Can you give us an idea of looking forward where you're seeing opportunities for the fund?
So if we look at both the historic alpha of the portfolio as well as looking forward, alpha can come from, call it, three sources. The first is referencing the buckets I referred to earlier of SA Inc., mining and then non-mining global sectors. A fund can derive alpha by shifting allocations between those sectors, and we do that on a dynamic basis. To give you a tangible example, the hallmark of our process is buying low and selling high. And currently the resources sector, with the exception of gold, but the resource sector at large, appears to be on very low valuations and earnings are not high either. So the odds are in one's favor to buy low. And it's a good opportunity to be increasing weight to that aggregate exposure. The second way alpha can be derived is through sector allocation. So even if we say that we at a benchmark weight in SA Inc., the composition of that SA Inc. aggregate exposure could look quite different. We could favor financials over industrials or vice versa. And even within sectors, say within financials, one could favor insurance over banks, which is what we are currently doing. And then the third way alpha has been derived and will continue to be derived is via stock picking. And you referenced this high conviction portfolio. Stock picking is the bread and butter of our process. And if we look at the stocks that have delivered the performance as well as our highest conviction positions today, there are numerous examples. What I'll draw your attention to is the 3M process that we follow. Currently, in terms of both the South African market and global markets, we're quite excited because there are a number of stocks that are scoring quite highly on those 3Ms. The quintessential example is Discovery. It's the largest holding in many of our funds. Strong competitive advantage, very aligned management team, and it's still quite cheap. So deep margin of safety.
So I think the global environment more recently has become much less friendly. And we've already seen growth expectations being lowered for the US specifically. But I think many investors are wondering, how does this impact on the prospects for local companies? And how is it likely to impact the return we see from South African equities going forward?
So as the adage goes, when the US sneezes, the rest of the world catches a cold. Hence, we cannot be oblivious to what happens in the US economy. It will affect all markets around the world. That being said, forecasts are currently just that growth has slowed down, not that we're in a full-blown recession. And a slowdown in growth from the US will actually be a net positive to global markets. As if we look at the last, call it 36 months, the US has sucked global capital from other markets because they've been growing faster than those markets. A reversal of that would be net positive. If it's a full-blown recession, then over the short term, whilst equities as a whole could be painful, there are certain pockets of equities that might do really well. One example is gold mining, that typically is quite defensive in recessions. And as the South African market, 10% of the market is gold miners. So the South African market could do better than many markets around the world because of that, as an example. Then to give you another example, in our funds, what excites us is idiosyncratic opportunities where the return is made almost regardless of the prevailing macroeconomic conditions. And to add color to that, I'll give you an example of a fund holding Supergroup. Supergroup today trades at around 28 Rand per share on the JSE. But what many people might not know is that while Supergroup is an SA Inc. company, more than half of the business is actually in Australia. Why that's catalyzed now into an event is because Supergroup have decided to sell the Australian business and pay the proceeds of that to shareholders via dividend. That dividend will be to the tune of 16 Rand per share. So if you go back to the maths, the share price is 28 Rand. They're going to give 16 Rand back to shareholders. That residual or the rump of 12 Rand is trading on a 5 times price to earnings multiple. That's incredibly low and discounts a lot of bad news already in the price. That's an idiosyncratic opportunity that we think should provide investors with a good return regardless of the macroeconomic conditions.
So, Mikhail, many investors looking at the market at the moment consider equities to be a risky investment. Now, we know normally equity funds are at the higher end of the risk spectrum, but of course they do reward investors in the longer term with real growth. Now, my question for you is, what should investors consider when they're looking at investing in a fund like, for example, the PSG SA Equity Fund?
So the first port of call is to discuss what risk is. And if risk is defined as volatility, which is often used interchangeably by market participants, we've got a slightly nuanced view around that, but let's assume volatility is what the market is worried about. Equities are not the asset class if one is concerned around 1 or 2 year volatility. Equities need a longer time horizon, and because it comes with higher return prospects. So I'll defer to the past before talking to the future. And if we look at the past 5 years, the SA Equity Fund has done 15.5% per annum. Over that period, South African inflation has averaged around 5.5%. So in the real terms, or net of inflation, the SA Equity Fund has done inflation plus 10% over 5 years. And if that's to 28 February 2025, so if we cast our mind back, the starting point is 28 February 2020. that means it's before the COVID crash. So even with the COVID crash, it's done inflation plus 10. That's a really good outcome. Over the long run, equities typically do between inflation plus 7 to 8% per annum. And over the long run, that is what's expected from equities. Obviously, we can't forecast that happens with certainty. But if you look at the fundamentals of starting valuations, prospective growth, and then the dividends that will be received, it's around that ballpark that I think the long run of equities, the return should be in place.
Mikhail, it was great talking to you today. Thank you so much for joining me.
Thank you, Adri. It was a pleasure.